Alright, so in this lesson we are going to discuss commodity prices and their effect on certain currencies, and we are also going to discuss the currencies known as the commodity currencies. So commodity currencies refer to the currencies of nations that rely on commodity exports to support their economies. If natural resources constitute a large majority of a nation's exports, then GDP and the underlying strength of the economy will be highly correlated to commodity prices. So some of these countries with liquid tradable currencies include Canada, Australia, and New Zealand. And of course, the respective currencies for these three countries is the Canadian dollar, or the three-letter currency code, that's CAD. Australian dollar is AUD. The New Zealand dollar is NZD. And so the Canadian dollar has a large amount of natural resources, including oil, natural gas, and timber. And as a result, Canada's economy is highly correlated to the prices of these commodities. Given that Canada shares a border and has close relations with the US, exports a lot of its natural resources to the US, and the strength and import volume of the US will have an impact on Canada's economy. So from that you can infer that if the US is doing well, and there's a higher volume of imports from Canada, then that will serve to benefit the Canadian dollar, and you would expect the Canadian dollar to appreciate relative to other currencies. So next, the second commodity currency we're going to discuss is the Australian dollar, or AUD. And so Australia is also a very resource-rich country and has large quantities of metals, including gold, coal, iron, and aluminum. In addition, the country is a large producer of wheat and beef. The Australian dollar's correlation to gold tends to be particularly important. So this is because Australia is a large gold exporter and relies on high gold prices to help support its economy. So the Australian dollar will exhibit material correlation to gold prices as a result. And many traders looking to express views on gold prices will often do so by buying or selling the Australian dollar. So if you do have a view on gold, if you think gold prices will be increasing, a good way to indirectly express that view, other from directly investing in gold, is through a currency such as the Australian dollar. Alright, so the third commodity currency that we are going to discuss is the New Zealand dollar, or NZD. And so New Zealand is also a notable commodity exporting country and has a large agricultural industry. New Zealand exports these commodities all across the world, and as a result, its economy and currency is greatly impacted by agricultural import volumes. So, if the world growth and activity around the world were to slow, that would naturally mean fewer imports of certain agricultural products from New Zealand, and that would have a negative impact on the New Zealand currency. While on the other hand, if you would expect an increase in growth and an increase in activity as well, that would mean more imports across the board, and then that would have a positive impact on the New Zealand dollar price. So one example that I wanted to provide was the commodities bear market that took place in the latter half of 2014 and during 2015 as well. So commodities, oil in particular, entered a bear market during this period, and prices were contending with lows seen during the financial crisis. So obviously things were pretty bad. And the price slump was ultimately caused by oversupply and fears of weak demand. Decrease in demand was driven by the growth slowdown in China and other emerging markets. Looking at oil prices during this period, so during the first quarter of 2015, prices were in the 40s per barrel, and then quickly recovered to the 60s by the spring, only to fall to lows in the 30s by year end. So I figured it'd be helpful to look at a couple of charts kind of conveying the correlation between certain commodity currencies and oil prices. So as you can see, this is the Canadian dollar. Well, this is the US dollar Canadian dollar pair with US oil prices, WTI, overlaid on top of this chart. So don't be misled by this, as we covered before, because US dollar is the base currency. Even though this is going up, this in effect means that the Canadian dollar is weakening, and that is ultimately because, as you can see, there is this material decline in oil prices, a very steep decline over an extended period, which, as Canada is a large exporter of oil, a fall in prices softens Canada's economy, and that did have a negative effect on its currency. So as you can see, the Canadian dollar did depreciate here as oil prices fell. So next we're going to look at the Australian dollar US dollar pair with oil prices overlaid. In this case, the Australian dollar is the base currency, so you can see a bit clearer that this is the Australian dollar weakening, and the prices in this chart are going down, and alongside oil prices going down as well. So there is material correlation between oil prices and these two currencies, as you can see in these charts. So moving on, the main factor that moves commodity currencies are commodity prices. So meaning when commodity prices are high, so will the currencies of the commodity currency nations. That being said, if you believe oil or commodity prices are going to rise, you could consider buying the currencies of commodity-based economies such as Australia, New Zealand, or Canada. Given the US is not as reliant on oil exports, the US economy is less impacted, so if you think oil prices are going lower, the US dollar works well as a pair with these commodity currencies. Alright, so that's the lesson on the commodity currency pairs, and I hope that was useful, and looking forward to the next one.